Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
And we're back with today's episode of Black and White Market Chatter on Life Planning 101. Matt Irvin and Aaron Kennedy with you today for our longer episode. I guess it's been a one whole month since we've been together for the long one, so we've got some good stuff lined up, I think. And, to kind of kick us off, Aaron, we talk about this a lot and have for a good while about our weakest weakness, right? The thing that could have hurt us the most.
Biggest fear.
Yeah.
We've talked a lot about that.
So kind of tell us, what have we seen? I think year to date is where we're kind of looking, and some parts of our biggest fear came true, but we got a plan to move forward. So kind of tell us about that.
Our biggest fear would be sitting around being defensive, trying to take care of everybody, and the market just skyrockets. And really, that's what's happened. 2022 was a pretty rough year, and then it just completely flip-flopped this year. And I would say it feels good that the market is positive, but the breadth of the market, or how much is actually working, has been so small. I mean, it's just mind-boggling. There's even a new term for it. It used to be the FANG.
Yeah.
That's all changed. Now it's called the Magnificent Seven.
Right.
And a lot of this has been gotten really popular because of AI. AI is going to be a game changer. May not be this week or this year, but it's coming. Okay, and people flooded into that really quick. But this Magnificent Seven is a lot of the names that we've heard before, like Apple, but it's Apple, Microsoft, Amazon, NVIDIA, Tesla, Google, and Meta, or what was Facebook. So if I take all those seven stocks and use the weights of how they're in the S&P, so far this year, those things have contributed about 22% of the S&P's return. 22%. The S&P 500 is only up about 19.
So what's the rest of it doing?
Yeah, so the rest of the market's down about 3%. And if you weren't in these seven stocks, then you really haven't seen anything in the market. And, when we were back in 2022, we were in probably one of the most expensive markets, period. From a percentile standpoint, we were in the 99th percentile of how expensive growth was compared to value. Today, it's a little bit better. It's 95. And you're looking at things like 1999, the internet boom. Mm-hmm. These were not good times to invest. So, our thoughts of safety first, it kept us out of there. We've been talking about this, be extremely high on the quality scale. We want to stay with a lot of companies that don't have a lot of debt load, and just be as safe as we could. And it hasn't worked out.
Right.
We are underwater. Now the good thing is, probably around May or June, somewhere around in there, we started to see more of the market start working. The advanced decline line, it kind of shows how many stocks are participating in the upside versus the downside. And we started seeing that trickle upwards just in the last couple of months. So more and more companies are participating in other than the Magnificent Seven.
So that's where, we talk about in high tides, all boats rise.
Yeah.
So instead of just those few that are, walking on air, the Magnificent Seven, we finally got some tides that are helping out those other stocks and kind of equalizing the performance a little bit. So.
And, so far this year, you've seen we've been pretty active. We've bought into the other side of the Magnificent Seven 3 different times. As that discrepancy kept getting wider and wider, we've been buying down. And we've been buying some fantastic companies. And probably over the last month to 3 months, our portfolio is gaining on the other side of the market. And if we can experience the rest of this year, everything else catching up, we will absolutely do the same. We will fall further behind if this craziness continues to go on. But we're in a much safer spot than being in these Magnificent Seven. Just to give you an idea, the PE of the S&P is sitting around 22, and that's still pretty expensive. But these Magnificent Seven, they're sitting a little over 106 times earnings.
All right, you gotta want to own those right now in a big way.
So think about this: those 7 stocks can drop 80%, and their earnings grow, and they'll still be more expensive than the market, and they'll still be fantastic companies. It's just this popularity contest that they're in has pushed them way beyond what is logical.
Right.
A couple of the things, you're looking at what the market is expecting versus what is happening. The market's expecting around 142% growth out of these companies.
Right.
We're sitting at a little bit less than 5% right now. So
got some room to grow.
And what happens on growth stocks when they don't hit their measurement? There's a rude awakening that happens very, very quickly, and there's really no fundamentals underneath them other than hope to get them to where they need to go.
So that might make earnings season a little brutal.
Yes,
this time
and it's
around.
coming this week.
Yep, it's coming.
Big chunk of them are coming out 40%. We've seen them both ways so far this year. some companies have done extremely well, and some have struggled, even in the same exact industry. So it's getting time to see who's swimming naked, as they might say.
Never heard that. No, that's great. Well, Aaron, thanks for diving into that. We're going to take a short break here, and then we're going to jump back into kind of our short-term view and then wrap up our third piece with the long-term view. So we'll be right back with you on Black and White Market Chatter on Life Planning 101. And we're back with round 2 of Black and White Market Chatter on Life Planning 101. Today's episode, in the first segment, we talked a lot about what we're doing as KFS in our portfolios and some of the things we're exposed to and how we've been reacting to that. And we're going to switch gears into kind of some short-term views, trying to wrap our head around what's going to happen here in the coming weeks, coming months, and kind of what our near-term view might be.
Yes. All right, short-term. Actually got this is pretty long on the note list. Short term, like I said, we're trying to make money in places that are not high on this technology list at this point. We do have some exposure, and we've been building a little bit just in case it continues to be crazy. But for the most part, we're trying to get in areas that are dirt cheap with high expectations. Japan's one of those, and it has a very interesting story to it. Just thinking of Japan, there's a new rule out there that says that they need to have a plan moving forward to be trading against above book value. And Japan has been pretty conservative, especially the leaders of companies and just corporations themselves. They hold a lot of cash.
Savers, big
time savers. So number one way to get that book value down is to distribute their cash. Japan's in a good spot right now. They're on a different schedule than we are. Their cycle is in the growth mode, and they're fixing to start sending us a bunch of cash or buying back shares like U.S. companies. So that's a good place to make some money where Tesla and NVIDIA are not there. So we're excited there. Also, some of our quality dividend payers. There's a little bit over $5 trillion on the sidelines. People are going to start looking at the market and say, I want some of that, because it's a lot bigger than 5% growth. And once that happens, like I said, everything's going to go up. And I said, see who's swimming naked. There's a saying out there from Matt. When the tide goes out, you get to see who's swimming naked.
That's right.
That's what I was talking about. But everything should advance. There's just too much money on the sideline, and too many dollars chasing too few stocks.
Yeah.
And they're going to get over-levered, and they will come back down. just think of NVIDIA. Do you think NVIDIA would be successful if it doubled this year? That would be fantastic. We'd have to drop more than 50% to be there. That's how ridiculous this is right now. I have to drop 50% to make a double this year. So we really don't want a whole lot of that in our portfolio at this time. But another short-term thing that we're speaking about that is outside the realm of the Magnificent Seven is oil. Oil's pretty fascinating at this point. There was a big research paper that came out earlier this couple of months ago, and what it was saying is that the oil in the Permian Basin should start rolling over within the next, let's say, 12 to 18 months. And what it's trying to say is no matter how much more we drill, we cannot push the growth of our Permian assets. It's been about a decade that the entire world's production growth has been right here in the U.S., and it's been the U.S. Permian and our new technology in drilling. That's coming to an end.
Wow. So can we touch on that? Because you had to explain that to me because I didn't fully understand the depth of this. So it's all about the pressures, right? You poke a hole in the ground, there's a lot of fluid down there. There's a lot of fluid down there, and there's a small hole coming out, lots of pressure comes out. So as we drain the fluid in the ground, there's less pressure. I think they call it pressure down the hole. I'm not a guru on this stuff, but I've heard that term before. So basically, there's not as much pushing it out of the ground. So there's still a lot there.
There's still a lot.
It's just getting to it. We might have to shift the way we're doing it, change our technology. What we're doing and what's been working may not work as well, right?
Right. Okay. Most of the wells that have been drilled have been the tier 1 wells, or the best of the best.
Mm-hmm.
And from modeling, these petroleum engineers and things have found that once an oil field gets to about 50% drilled, that pressure decreases quite a bit, and the growth starts to move into decline.
Mm-hmm.
It worked out almost exactly as thought in the Bakken fields. In the Eagle Ford was another one that it worked out, and we're about to hit that in the Permian. We're about 40% right now. So in the next 12 to 18 months, we're going to start to see some decline. And if the U.S. doesn't have the production to slow the increase in prices, oil is going to go up in value, and it's going to go up a lot. We don't have our strategic reserves to deplete any longer. That's actually got to be filled back up.
Yep.
So not only do we need it for trucking and travel, but plastics, but we've got to fill that strategic reserve back up, and the oil's just not going to be there. So that's something to really look at, and that is some tailwind for some of these energy companies. They had a fantastic 2022. Is one of the very bright spots in the market. It's been a negative spot so far this year, but I think you should expect that to change, and you're going to want some of that in your portfolio one way or the other. So
Aaron, tell me this. So if we do go into a recessionary period where people aren't driving as much or aren't using as much fuel, will that help the reserves there?
Not at this point. That was something else that was in that research paper, that the demand for oil has never dropped as much as what the supply is going to drop.
Right.
Never. No matter how bad the recession, we still need food. We still have to transport things. We still go see grandma. We do all these things, and it's not going to be enough to help prices.
We can't lower consumption enough.
Right. Supply is going to be way under what demand is, and pretty much no matter what we do. So that's going to put upwards pressure on oil.
On pricing.
And what's that going to do for inflation? And if inflation is being propped up, from the price of oil, just think about that. Remember when we were sitting double the price here, how painful it was to go fill up your car. Think of how fast price of eggs increased, and all the transportation costs just to get the food to the grocery store, to Walmart. That's going to pick back up, and we're not going to have any more of the tools to keep that down.
Well, because you cannot control interest rates, or you cannot control that with interest rates.
No.
Right,
Absolutely
that's a completely different piece. But I hate to cut you off there. We do need to take another quick break before we go into our last segment of today's episode of Black and White Market Chatter on Life Planning 101. Finishing up our final piece of today's episode of Black and White Market Chatter on Life Planning 101. We've talked about the current, we've talked about the short term. Now we're going to talk about the long term. Aaron, what are we seeing for long term kind of environment and maybe some long term opportunity?
Yes. Touched on this a little bit. Higher inflation. The Fed's tool to fight higher inflation is higher interest rates. Our interest payments is a little bit over $600 billion right now. Our deficit, our spending deficit is a little over $1.6 trillion. We are going to have to continue to print money and continue to borrow so our government continue to operate.
Just support the debt service.
Yes, and that's going to have several consequences. Number one, the U.S. dollar is probably going to start to lose some of its appeal. It's going to get to the point that we just cannot make our payments safely.
Mm-hmm.
We can continue printing. As long as the rest of the world's printing, we should be okay, but,
it's not a good contingency plan.
Yeah, it's not something we want to hang our hat on. And, on the other side, what happens if this AI comes to fruition? If we have a computer setting all appointments and doing all the back work and we don't need people to do that manually.
Or how about flipping burgers? Or what was the deal of the avocado robot with Chipotle? And
yeah,
I mean, it's here.
It's here, and we're going to see unemployment skyrocket. Unemployment skyrocket means our government's not going to get the tax receipts that it needs. So then we're even going to be in more of a deficit, and it just starts to steamroll. And hopefully before we get to that point, Fed can get interest rates back down naturally, but at that point we're going to be looking at a risk scenario where they're going to have to pay out the wazoo
just
to
for
have
debt.
Anybody to hold that debt. So that's really not a place you want to be. You don't want to be investing in long-term government bonds. You probably don't even want to be in long-term corporate debt, because it's it's going to be a loss leader for you. And we've gone decades upon decades of having that be safe money, and that just will not be the case.
Right.
And we're talking long term, so maybe 2030, maybe 2050, but it's not the place you want to be, and you need to be getting ready for that. The place that you will be making money is stocks. They will continue to do well. On the stock side, probably need to be leaning more towards the companies that are creating this discrepancy, some company that is creating deflation, that it's improving efficiency, high technology stocks, or very cheap companies that are paying a decent dividend. You're going to have to look at things different, but that's the way you're going to be able to climb out of this, because if you got government debt and your real return, if you're getting 5% treasury interest, but inflation's 10,
going backwards.
Yeah, that's a negative real return. So really the only place you can get a positive return at that kind of inflation levels is going to be in the stock market. So you're going to want that, and you're probably going to want to have something that's anti-US dollar. While we're living here in this country, we probably won't be affected as much. Of course, the things that we bring in from other countries, those are going to go higher in price, but it's going to give us the opportunity to bring onshore a lot of those goods and services. But still, if you need to go out of the country, you need to buy something, U.S. dollar is going to be coming down. So how do you combat that? And there's not a lot of things out there. Maybe gold, maybe some Bitcoin, something like that does the opposite. So you got to kind of think of your portfolio differently. Where's my growth? Where's my anti-dollar? Where's my safety? And putting all those together, that's how you're going to need to look at your portfolio. And yeah, it's going to be more volatile. but you can either get paid for that volatility or you can go broke safely.
Right.
That's the thing my dad loves to say, going broke safely, because we're getting close. Go to that world, U.S. debt clock. If you go Google that, it's terrifying, absolutely terrifying. Just to give you an idea, we hit 32 trillion in debt, and golly, what was it? End of May, beginning of June, and now we're at 32.6 trillion. Blink of an eye.
Shoot.
We blew through that, and we're just continue to run, and it's not going to slow down, guys.
Yeah. So let's try to sprinkle this little positivity, because all I hear is the dollar's not going to be good, and the technology. I know that there's certain parts of technology right now, kind of based on our first part, we're trying to steer away from because it's so overpriced. But so we're kind of, that's where that next level, getting under the hood,
Yes.
being able to dig a little deeper than what's on the headline of Google, right?
Right. How this is going to affect people that the lower risk investor,
Right.
because there won't be a lot of safe assets out there to be invested in and get you a comfortable.
Because the safety,
return.
the risk-free rate is U.S.
Yes.
debt. Well, if the risk-free turns into risky, you
Right.
can TM that if you want. Then we have an issue with their underlying,
Yes.
right? And so then that kind of breaks that model where we base off the risk-free rate. You
Yes.
know, we're still going to have to pay. Interest rates absolutely matter, but we're going to have to be willing to accept. And two, I think based on what we're seeing, it's more volatility risk, right? Because if we do our homework, if we do our math, we stick to the quality companies, volatility is going to be there, but the actual risk of the underlying, that's where we're trying to get super defensive and more qualitative.
Yes,
So-
that's exactly right. Just buy great companies that are doing the right thing, and you should be okay. We're always going to have market volatility,
Right.
but what we don't want to see is the risk of our company going away.
Right, going poof, going
Yeah.
to zero.
We don't want to see any WorldComs or Enrons, anything like that. So you got to be careful with what you buy and just be okay with higher volatility. And hey, you know what? We've been pushed this way for well over a decade. How long has interest rates been at zero? So most people have gotten more comfortable with adding more and more risk. So we're just going to continue down the same path there. This little reprieve of getting 5% CDs is, it won't feel as good here in the future.
Well, and two, do your homework, right? Because there's lists and lists upon lists of investments to go into that have the saving grace or the magic formula, right? You've seen them much more than I, but somebody always wants to sell you a list of stuff to buy. It's usually the stuff they're trying to sell.
That's exactly right.
So be careful out there, because in volatile times and uncertain times, there's people out there that actually will try to take advantage of you. I know it's a surprise to people like me, because I don't think that exists, but use your professionals. If you're with us, call us. If you're not with us, give us a call anyway, right?
Yeah.
We want to help you, want to work through it. So
If it's too good to be true, more than likely it is.
it sure enough is. That's right.
Stay safe out there.
Well, good deal, Aaron. We do have to get wrapped up today. Thank you for going through that again. Our where we're at, where the short-term look is, and where the longer-term look is. If you missed any part of this today, give us a call. We'll talk you through every bit of it. But thank you for joining us on today's episode of Black and White Market Chatter on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Don't forget to learn how our sister company can assist you with all of your tax, bookkeeping, and consulting needs. You can find out more at briscoeandassociates.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group, LLC. Kennedy Financial Services and Smart Money Group, LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.